Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Bob Yawger, Senior Energy Analyst at Mizuho Americas, with an update on the energy complex and, of course, the supply and demand picture. Bob, it's great to have you with us. Welcome back to Trade Talks.
Thank you, Jill.
All right, looks like we had a little bit of movement in crude oil since the last time we spoke in July.
Yes, we did. We traded to a 5-month high last week. A very interesting situation, 43.52. But we do have this resistance that kicks in at about $42, speaking. The market's having a lot of trouble getting above and beyond that. For that matter, we're trading 41.94 right now, which is unchanged. We're down 100 points. We're down $1 from the high from today. We made a run at that 43.52 high and then traded lower, minus 100 points. So big slide on the day. We do have an EIA storage report tomorrow. Last week, we traded that 5-month high just in front of the storage report. Despite the fact that the number came in a big 7.6 million draw, we still traded lower on Wednesday. And that was because storage at the NYMEX delivery site at Cushing was higher for the 5th week in a row. And storage at gasoline was higher for the 2nd week in a row during peak driving season.
If we move along to our next chart here, we're taking a look at RBOB. And for the benefit of the audience, explain what RBOB is and what you're looking for.
RBOB is a type of gasoline that is specific to the East Coast. It's basically New York Harbor gasoline. That's the NYMEX spec. What that means is you're looking at the crack. It's basically what is going higher or lower faster, crude oil or gasoline. You're basically gasoline is priced in dollars per gallon. Crude oil is priced in dollars per barrel. You're converting the gallons into barrels, actually. And right now, if you run a barrel of crude oil through the refinery, you're going to come out with a barrel of gasoline at about $9. That's a horrible number for refiners. They lose money basically on anything less than $10. That crack during peak driving season should be trading out towards $20, $15 to $20 at least. But it is trading below $10 now. That is really bad. And yes, on Friday, for the first time since June 26th, the heating oil crack and the gasoline crack they both settled below $10. That's very bad because you're not making money on anything coming out of the refinery at that point. What ultimately happens then? Refiners will pull back on the refinery utilization rate. They'll stop making less product because they're getting killed on it. What happens then? You don't run as much crude oil through the refinery. That crude oil gets stuffed in the storage. Storage gets higher and puts pressure on crude oil prices.
Well, Bob, I mean, how long can refiners go on like this? It doesn't seem like the demand picture is going to change that much going into the 4th quarter. There's still a number of macro uncertainty and outliers out there. How much longer can they go on?
There's not a lot of good touch points here. First of all, they're only running at 79.6% of capacity. Last year at this time, we were running at 96% of capacity. It's over 2 million barrels less crude oil going through the refinery than last year. That's a gigantic number. And we still can't burn through crude oil at a gigantic level. We're only about 20 million barrels away from the all-time record in crude oil storage. We're about 15 million away in gasoline, all-time record high storage. Distillate storage, that's heating oil, is already at a 38-year high. There's so much distillate in storage that refiners are not going to need to make a lot of heating oil for winter. So that refinery utilization rate is never going to skyrocket. That's going to continue to send barrels into storage and continue to put pressure on crude oil prices.
All right, so Bob, with that in mind, let's talk about the natural gas outlook. It starts to get cooler up in the Northeast once we get through, the hot pocket of August and September. Doesn't sound like the outlook's going to be good for that either.
No, it's not really. We have put in a pretty nice rally as of late, and prices have rallied above and beyond. We were trading or threatening to trade to 230 here the last couple of days, and but we have pulled back today. We're trading about 217 right now. The market has been threatening to go above and beyond, but there's really no fundamentals supporting this rally. This is a spec-driven rally. The amount of spec position, that's basically people who are just trading on their own accounts, including funds. They are loaded up for a 2-year high right now. If you take all 7 of the 9 of the Henry Hub related contracts on ICE and NYMEX, there's a spec position as at a 2-year high. That's crazy. But what they did, we traded a 25-year low at the end of June, $1.43 for natural gas. It was interest rates so low, investors are just dying to get involved in some kind of financial instrument that it's beaten down. Well, they found their instrument in natural gas. They pushed more positions, jumped into the position every week, and they pushed all the way to a high of 226.10 late last week. We're struggling to hold that number now. Storage is way above last year levels. So it doesn't really make any fundamental sense for this rally. But when you look into the spec position, voila, there's your reason for this big spike to the upside. This happened to a lesser degree, only by about 10 cents at the beginning of May. They pushed the price up to pretty close to 220, and then we tanked. As all those spec positions got out of the natural gas position, they took that market down to $1.43, a 25-year low. I'm not saying it's going to happen necessarily this time, but the RSI that's the momentum indicator, was above 70 last week. It's below now, and natural gas starting to give back some of that price. I would be careful in that space.
All right, Bob, appreciate the insight as always. Thanks for joining us on Trade Talks.
Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.